Hello friends, in this lecture we will continue with our discussion on admission of a partner. In this chapter we were discussing about the topic of goodwill. What is goodwill? Goodwill is the reputation earned by the partners over a period of time. Now, why we are studying goodwill in admission of a partner? Because the new partner who will be joining the firm will enjoy this reputation which has been earned by the old partners, right? So for that he must compensate the old partners for enjoying this goodwill, this reputation that has been earned by the old partners, right? In that we discussed two cases. First, that the goodwill is paid privately. I told you if it is paid privately, then we will not record anything in the books. Second is, goodwill is brought in cash by the new partner and it is retained in business, right? And I told you one more thing, that as per accounting standard 26, the goodwill is not to be shown in the books in case of admission of a partner. The goodwill will be adjusted through the partner's capital accounts. Clear? So if it is to be adjusted through the partner capital accounts, then in which ratio the goodwill brought in will be divided among the old partners? In sacrificing ratio. What is a sacrificing ratio? Old share of a partner minus new share. Clear? So in case of goodwill on the admission of a new partner, we will calculate the sacrificing ratio, right? And we will distribute the goodwill brought in by the new partner among the old partners in sacrificing ratio. Clear? And in this process, even an old partner can also gain. If the old partner is also gaining, he must compensate to old sacrificing partner. Clear? So this is all what we have studied. Let's see few more practical problems. In the last lecture also we did 3 practical problems. We have 2 more good practical problems on this topic, that when the goodwill is brought in cash and retained in business. Clear? So let's see the practical problem. The problem says X and Y are partners in a firm sharing the profits in the ratio of 4:3. On 1st of April 2016, they admitted Z as new partner. Z brought in 1 lakh for his capital and 21,000 for 1/3 share of goodwill premium. On Z's admission, the goodwill appeared in the books of the firm at 28,000. Record the necessary journal entries on Z's admission. See, this is a very simple problem. There are just 2 points which are important here. The first one is, it says on the Z's admission, goodwill appeared in the books of firm at 28,000. I told you in the previous lectures that if there is any goodwill appearing in the books on the date of admission of a partner, any goodwill appearing in the books on the date of admission of a partner, we will write off that goodwill among the old partners in old ratio, because that reputation has been earned by the old partners, right? We can't give that reputation to the new partner. So we will divide whatever is appearing in the books among the old partners in old ratio. Let's first of all write down the facts. There are two partners, X and Y. In which ratio they are sharing the profits? In the ratio of 4:3. And the new partner Z is admitted. What is the share of Z? 1/3 share. 1/3 share in profits. What is the amount of capital brought in? 1 lakh. What is the amount of premium for goodwill brought in? 21,000. What is the amount of goodwill appearing in books? This is 28,000. So make a note here. Write down note number 1. If at the time of admission any goodwill is appearing in the books, any goodwill is appearing in the books, it has to be written off among whom? Old partners. In which ratio? Old ratio. Because this reputation, this goodwill has been earned by old partners before the admission of new partners. So I told you in the very beginning, anything which has been earned before the admission belongs to the old partners in old ratio. Right? Make a note number 2 here. See, I told you that we need a sacrificing ratio because the premium of goodwill that has been brought in by the new partner will be distributed among the old partners in sacrificing ratio. For the sacrificing ratio, we need the old share and the new share. In this question, new share is not given. Now, how to find out the sacrificing ratio? Very simple. I make a note here. If only the old ratio is given, old ratio of old partners, and the share of new partner is given, then sacrificing ratio will always be equal to the old ratio of the partners. Right? I have told you this, mathematically proven this in the previous lectures. You must go through those lectures when we discussed about the sacrificing ratio. Make a note here that if only the old ratio is given and the share of the new partner is given, then sacrificing ratio will always be equal to the old ratio. In this case, what will be the sacrificing ratio then? In this case, sacrificing ratio will be old ratio, that is 4:3. Now, after these two notes, the question becomes very simple. This goodwill we say that is appearing in the books at 28,000, we have to write it off, right, through the partners capital accounts. So we will pass the journal entry for this first. Goodwill is an asset. If we have to write off the asset, we will debit the asset or credit the asset. Think. We have an asset. Goodwill is our asset. It is an intangible asset for us. We are writing it off from the books. We will credit the asset. And what will be debited? The partners' capital accounts. Which partners? Old partners. Who are the old partners? X capital account debit, Y's capital account debit to which account? Goodwill account. What is the amount of goodwill? 28,000. In which ratio this goodwill will be written off? In the old ratio, that is 4:3. That comes to 16,000 and 12,000. What will be the second entry? Now the new partner enters the firm. New partner brings in capital and also brings in premium for goodwill. I can say bank account debit to capital account. Capital is 1 lakh. And how much is the premium for goodwill? 21,000. Premium for goodwill is 21,000. So the total amount that has been brought in by the new partner is 1,21,000. Now further, this premium for goodwill is for the old partners. We have to adjust it through the old partners capital account. We'll pass the third entry. We'll say premium for goodwill account debit and the old partners, that is the sacrificing partners, capital accounts will be credited. In which ratio? In sacrificing ratio. What is the amount of premium? 21,000. What is the sacrificing ratio? I just told you, if the old ratio is given and the share of new partner is given, then the sacrificing ratio will always be equal to the old ratio. So the sacrificing ratio is 4:3. We will divide this premium in the ratio of 4:3. This comes to 12,000 and 9,000. Clear? So this is the solution to this problem. You can write it down. Clear? So there was two major points here. First was, if at the time of admission any goodwill is appearing in the books, it has to be written off among old partners in old ratio. Right? Note number 2, if only the old ratio is given and the share of the new partner is given, then sacrificing ratio will always be equal to the old ratio. Clear? And this was the solution. Next, let's see the next practical problem. A very good one. Following is the balance sheet as at 1st April 2016 of Sushil and Satish, who are in the partnership sharing profits and losses in the ratio of 5:2. The balance sheet is given, and it is given that there are two partners, Sushil and Satish, who are sharing profits in the ratio of 5:2. What are the assets? Bank, stock, debtors, plant and machinery, building, and the liabilities are sundry creditors, capital accounts of Sushil and Satish. On the above date, what is the above date? 1st of April 2016, they admitted Samir as the new partner on the following terms: that Samir will bring in 1 lakh for his capital and necessary amount of goodwill premium for goodwill. And what is the share? 3/8 share in the future profits. Goodwill of the firm on the Sameer's admission was valued at 1,40,000. It is the goodwill of the firm. Be careful about this, whether it is given that it is the goodwill brought in by the new partner, or it is given that it is the goodwill of the firm. The new profit sharing ratio will be 2:3:3. Right? Very simple question. Let's see. Let's write down the facts first. There are two partners. Who are the two partners? Sushil and Satish. Sushil and Satish. What is the profit sharing ratio between them? 5:2. Right? Profit sharing ratio is 5:2. Who is the new partner? New partner is Sameer. He is the new partner for 3/8 share. What is the new profit sharing ratio given? That is 2:3:3. The first step, I told you, calculate the sacrificing ratio. In any case, we need the sacrificing ratio. So first of all, we will say calculation of sacrificing ratio for Sushil. What is the old share? 5/7. What is the new share? 2/8. 56. This comes to 26/56. Right? Let's see for Satish. What is the old share? 2/7. New share 3/8. 56. And then it comes to 16. Now this is again, this is 5. This is again by an old partner. Now I told you, if the old partner gain in this process, he must also compensate the old sacrificing partner. Who is the old sacrificing partner? Sushil is the old sacrificing partner. Right? Now let's see the amount of goodwill payable by the new partner and the amount of compensation payable by the old gaining partner. Amount of goodwill premium by whom? Sameer. So what is the total amount of goodwill? What is the total goodwill of the firm? It is given as 1,40,000. Okay, we say 1,40,000. What is the share in the profits for Sameer? See, he is admitted for 3/8 share. So he will pay only that part of the goodwill to the extent of the share in the profits he is gaining. That comes to 3/8. And this amount comes to 52,500. Right? Now, amount of compensation payable by whom? Who is the gaining old partner? Satish. Amount of goodwill. What is his gain? 5/56. So this amount comes to rupees 12,500. Easy? Always calculate the sacrificing ratio. Identify if the old partner is also gaining in this process. Then accordingly calculate the amount of goodwill premium by the new partner, and if the old partner is also gaining, then amount of compensation payable by that gaining partner. Clear? Now let's pass the journal entries. See if there is any goodwill appearing in the balance sheet. No. If there was any goodwill appearing on the asset side of this balance sheet, we would have written off that goodwill first. Like in the previous question I told you, if there is any goodwill on the date of admission appearing in the balance sheet, appearing in the books, we will write off among the old partners in old ratio. No goodwill. Let's pass the entries. The Samir, who is the new partner, he is bringing 1 lakh as capital also, right? And 52,500 as goodwill. So what will be the journal entry? Cash account debit to capital account. How much is the capital? 1 lakh. To premium for goodwill account. What is the premium for goodwill? 52,500. What is the total amount brought in by the new partner? 1,52,500. Now this premium for goodwill will be adjusted through the partners' capital accounts. Premium for goodwill account debit 52,500 to who is the sacrificing partner? Sacrificing partner is only Sushil and not Satish. Satish is the gaining partner. So this premium, all of the premium will go to Sushil only, to Sushil account. Now Satish also has to compensate Sushil. So I will debit the Satish capital account with 12,500. So what is the total? This comes to 65,000. This Sushil will get. Clear? So these are the two journal entries. First of all, the new partner is bringing the capital and the premium for goodwill. Then that premium of goodwill will be paid to the sacrificing partner, who in this case is only one partner, Sushil. And the gaining partner will also compensate the sacrificing partner, right? So these are the journal entries in this case. Be careful, if this balance sheet shows any goodwill, you have to write off that goodwill first, then you have to pass any other journal entry. Clear? So this is all with the case 2 of goodwill. Case 2 of goodwill, where the goodwill was brought in cash and retained in business. We have done practical problems, and in the next lecture we will move to the next topic. Next lecture we will move to the case 3, where the goodwill is brought in kind. In kind means in form of some asset. How we are going to deal with that, we will see in the next lecture. Right? This is all for this lecture. Thank you, friends.